Thank you very much for joining us today for our webinar. I'm Jim Hagerty, and on behalf of the entire firm, we're very, very grateful that you're with us. Three of us are appearing from Cincinnati, where we're enjoying bright blue sunny skies, and try as we might with the blinds and so forth, some of that sun is filtering into our offices and shining up our faces and so forth. So we hope you don't find that off-putting. But we're very, very grateful that you're with us. We have a terrific panel discussion that will be moderated by our president, Holly Mazzocca, and will feature an excellent lineup. Matt Stith, a portfolio manager and director of our equity strategy. Matt is a CFA. He's in his 17th year with the company. Kyle Pohlman, in his 20th year with the company. Like Matt, he's a CFA, a chartered financial analyst, and he's a wealth advisor. And appearing from Chicago, Melissa Mabley from our Chicago office. Melissa is a certified financial planner, CFP, and one of our best in the Chicago office. I should point out, Holly Mazzocca, Matt Stith, and I are appearing from the Cincinnati office. Kyle Pohlman is on a business trip with Lori Poole. Many of you know Lori Poole, and they've been visiting clients this week in Santa Monica, Laguna Beach, and Long Beach, and so Kyle is appearing from out west. Very grateful for a terrific turnout today. We've seen a lot of growth. Last week we had an on-site version of this at Cooper Creek in Blue Ash. We had 200 attendees, up from 117 last year. Week prior to that, we had this seminar in Chicago, and we had 75 attendees, up from 50 a year ago. And today in this digital version, we have 358 people joining us, and that's up from 290 a year ago. So 358. That includes some clients tuning in from the United Kingdom and also Australia. So very, very grateful for such a great turnout. I'm going to spend just a few minutes giving you an update on the company. 2023 has been a good year for Bartlett. We are on track for, I think, in excess of 98% client retention. We measure that assiduously every year, 98%. And also what appears to be a record year in terms of new client additions. And our clients tend to come to us by way of word of mouth, generous referrals from existing clients who mention us to their friends and their family and their business associates. And so many of you listening today made that possible, and we're very, very grateful for such a good year in terms of new business. We're always anxious to help more good people. Of course, we'll remember 2023 very fondly as a momentous anniversary year for the company, our 125th anniversary. It was way back in 1898 that a man named Benjamin Bartlett bought a seat on the New York Stock Exchange and began what we now know today as Bartlett Wealth Management. So from a fledgling enterprise in 1898 to now a firm with more than $8 billion in assets under management, serving clients all across the country and some outside the country. So a really momentous year for the firm. Interestingly, when Benjamin Bartlett started the company in 1898, the Dow Jones Industrial Average was around 40, and here we are around 34,000. And over 125 years, that works out to about 6% growth, and adding in dividends, about a 9 to 10% annual return. So just the kind of progress we talk about and aspire to. But a marvelous 125 years, and we're not resting on our laurels. We want to be around for 125 more. And another highlight of 2023 is that we added an office in Louisville, partnering with a firm there, 4 terrific individuals. We since that time have recruited a fifth. And as many of you know, Louisville is just a 90-minute drive from Cincinnati. We have a good client following in the Commonwealth and anticipate even more growth. So the wonderful addition of Louisville to go along with the addition of Chicago that we did 5 years ago. A couple of other highlights for you. A few years ago, we launched under leadership of Holly Mazzocca something called We Invest, a wealth management platform designed specifically for the unique needs of women. And this year, we started what we think will be an annual scholarship program where we scholarship a very, very promising young lady. This year's recipient of our Future of Finance Scholarship, you see her on the screen, Kenya Dennis. Kenya is a student at the University of Cincinnati majoring in cybersecurity. So she has a very bright future, and we're glad to be part of it. All of that under our We Invest program. We also introduced a platform of services for business owners called Business Owner Services. And this recognizes that business owners, entrepreneurs, small businessmen and women have unique needs, all the usual wealth management needs around good investment management, good financial planning, astute tax planning, but also needs in other areas you may imagine, such as succession planning. So we introduced that, and that's off to a good start. And growth and innovation like this is being recognized. We're very, very pleased to get some nice recognition and awards this year. I was especially pleased that both Barron's and Forbes named Bartlett to their roster of the top 100 registered investment advisors in the country. So some very, very nice recognition. We celebrate these things, and this year we celebrated at our 2023 Advance. We've been doing this for about 10 years now. Some firms call these things retreats. They get everybody together for strategic thinking and planning. Our former CEO, Kelly Downing, took to calling it an advance. We don't retreat, we advance. And our 2023 Advance was a very, very productive 2-day session this summer. United everyone. We don't just do this at the management level, united everyone from our Louisville, Chicago, and Cincinnati offices for 2 days of off-site meetings downtown. We actually, this year, we centered it at TQL Stadium, home of our highly successful soccer team. We used a few conference rooms there and had breakout meetings in the stadium, which was a lot of fun. And then we had lunch and dinner meetings and fun throughout the over the Rhine area here in Cincinnati. So it was 2 days of strategic planning and good, clean fun involving everyone. So already looking forward to doing that in 2024. So that's, I think, an encouraging update on the firm, another good year and planning for more. And with that, I'll conclude my remarks and let Holly Mazzocca take over with this terrific panel.
Thank you, Jim, and thank you to all of you for joining us here today. It's wonderful to see so many of you online with us here. As a logistical reminder, please submit your questions through the Q&A functionality down at the bottom of your Zoom screen. We will leave plenty of time for those at the end of the presentation, and Maggie Spataro will be organizing those throughout today's conversation. So as we got together to discuss this theme of navigating a changing world, our team thought about all of the changes that we wanted to go over with all of you today. In the interest of time and making sure that you can get on with your day, we are narrowing it into 3 key changes. The first of those, Matt Stith will cover highlights in artificial intelligence and what these changes mean for investors and for our economy. Kyle Pohlman will be walking us through changes in the interest rate landscape, notably higher interest rates and more persistent inflationary numbers. And finally, Melissa Mabley will guide us through a conversation around changes in the financial planning landscape as it relates to these market forces at play and also policy changes at play. The common theme throughout all of these topics is change, and it's our role as your advisor to help navigate these changes, simplify the complexity, and guide you towards financial peace of mind. Before we jump in with our panel today, let's take a quick look back at where we've been in 2023. We've already had lots of ups and downs with plenty more to go before we cap it out here in the calendar year. So when we came into 2023, we were coming off of a really difficult 2022. Inflation was still higher, but it was coming down. We entered the year with a reading of 6.5% on the consumer price index. And markets liked this idea that inflation was coming down. We had a strong start to the year with a rally in January and February. We hit a bump in the road in March, notably with the banking turmoil. While the S&P 500 was down about 7% during that March decline, the overall regional banking index was down over 40%. So certainly some significant declines in pockets of the market. As we went into the second quarter, the name of the game was optimism. Optimism around the idea of continued good economic numbers, and also optimism around artificial intelligence and what this theme means for the markets, which Matt Stith will be highlighting for us. As we went through the third quarter, a bit of realism set back in as the Federal Reserve made some announcements that really had the market believing that interest rates were likely to remain higher for longer, which Kyle will guide us through. Throughout the third quarter, we also had continued gridlock in Washington, and Melissa will talk to us about what some of those policy changes or not changes mean for investors in their financial plans. As we sit here today, we've seen a recovery in the markets in the period since the end of the third quarter. The mother market continues to confound us. We had a 10% correction towards the end, as you can see that dip down at the end of that line there at the end of the third quarter and into October. But we've since had a very nice rebound. So the S&P 500, as we sit here today, is up about 17%. Now, Matt's going to highlight just how concentrated that performance has been in the markets. And when you look at broader stock markets, whether that's the Russell 2000, which is just sort of barely up for the year, that's small cap stocks, or if you look at international stocks, they also haven't fared as well as those large cap growth oriented stocks here in the United States. We've also seen a rise in longer term interest rates. So on those long-term interest rates, we actually hit a 5% rate on the US 10-year Treasury. And when we hit that number, a lot of the pundits in the markets were thinking, man, what's next? Probably 5.5%. Well, sure enough, it's actually down now back to about 4.5%. So again, it's really difficult to know exactly where those interest rates are going, but Kyle's going to walk us through some of our thinking around that. We also ended with a very good inflation reading this week, with overall consumer price index dropping from the 3.7 rate that you see here at the end of September to 3.2%. So good news on the inflation front, but still some persistent lingering items there. We also recognize that there are continued global conflicts, which do add quite a bit of volatility to the marketplace, and we are happy to answer any questions about that during the Q&A as well. So with that, let's jump in with our panel here. I'm going to kick it off with Matt Stith. Matt, as I mentioned, we've seen a tremendous focus this year on the power of artificial intelligence in the stock market. As we think about navigating a changing world, how do these technological changes come into play?
Yeah, so as we think about our theme, navigating a changing world, and what this means from an investment perspective, one of the biggest catalysts to stock market performance this year has been the excitement around artificial intelligence, and more specifically, generative AI. Market returns have been fueled by a small group of stocks, often referred to as the Magnificent Seven. These include Facebook, Apple, Amazon, Google, Microsoft, NVIDIA, and Tesla. And while AI hasn't been the only catalyst behind the strong performance of this group, it has certainly been a significant factor. To highlight just how influential this small group of stocks have been, we can take a look at this chart. So for example, the solid black line represents the return of the S&P 500. And at the time we put this chart together, the market was up about 10.6%. The large reddish area represents the Magnificent Seven. This group of stocks, again, at that same time, was up about 10.5%, so capturing nearly all the returns of the market. Finally, the small grayish area represents all stocks in the S&P 500 other than the Magnificent Seven. This group of stocks is up only about 0.1% today, so something well below what an investor could earn just by holding cash in today's market. Kind of worth highlighting is that, over the last month and a half, we have definitely seen some volatility increase in this group. And as we've seen in the market, for example, Tesla is down about 15% since the time this chart was put together. And some of these other names have showed some increased volatility in recent weeks as well.
So how do these technological changes impact your investment thinking?
Change is an inevitable part of investing, and it's one of the reasons that I really enjoy my roles as portfolio manager and director of equity research here at Bartlett. Sometimes changes are small and they don't really have meaningful investment implications. However, other times, like what we are seeing today with AI, do have the potential to be significant and certainly merit a closer look. To highlight these changes, the chart you're looking at shows the most significant periods of technological innovation over the past 50 years and how market leadership has been impacted as a result. In fact, none of the market leaders from the 1980s or 1990s currently hold a top 10 leadership position today. A lot has changed over the decades as we have moved from mainframe computing to the explosion of the internet and more recently to cloud computing and mobility. And as we sit here today, many industry experts feel we are on the cusp of this next period of significant technological innovation, which will be fueled by artificial intelligence. So thinking about this idea of market leadership change from an investment perspective, it's important that we understand how a powerful theme like AI is impacting client portfolios today and how it's likely to impact portfolios in the future.
So some of the excitement around AI stocks is somewhat new this year, but this is not necessarily a brand new technology. What can you provide a little bit of historical perspective?
You're exactly right, Holly. While AI feels new, it's actually been around for a really long period of time. In fact, AI dates back to the 1920s with significant breakthroughs in what's often referred to as the birth of AI taking place in the early part of the 1950s. So let's take a step back for just a second and define artificial intelligence. Artificial intelligence is the ability of a computer or a robot to do tasks that are normally done by a human being. So the chart you're looking at now shows the evolution of AI over the decades. And thinking about the early 1950s, the use cases were pretty simple, with computer programs written to play games like chess or checkers. In the late 1990s and early 2000s, we were introduced to consumer products that were embedded with AI technology. And a more recent example, and one that I think many of us use in our daily lives, are our voice-activated digital assistants, Siri and Alexa. We use these digital assistants to help us perform a number of our daily tasks, and all through the use of voice commands. And while this technology is far from perfect today, I think this is an area where we see tremendous improvement in the not too distant future.
So what makes this time different?
The simple answer is the evolution of generative AI. So whereas traditional AI can perform specific tasks based on predefined rules or patterns, generative AI goes beyond with the ability to create entirely new data that resembles human-created content, such as text, video, audio, and even computer coding. Generative AI, it's more interactive and human-like. It's conversational and collaborative. So for example, I recently asked ChatGPT, which is an AI chatbot, what I should pack for an upcoming hiking trip. The answer I got was very detailed and very human-like. It was suggested that I bring specific clothing, camping gear, food and water, and other miscellaneous supplies. And I was reminded to leave no trace and to be respectful of wildlife. Really, the only thing I didn't get were driving directions to my campsite, but I think that's something that we're going to get over time. What's equally impressive about this technology is that it has gone mainstream and is available in certain forms to you, me, and just about anybody who wants to use it. The chart you're looking at right now shows that it took ChatGPT only 5 days to reach the 1 million user level. This compares to other popular platforms such as Netflix, where it took about 3.5 years, and Facebook, where it took 10 months. And of course, all this wouldn't be made possible without the continued evolution in technology and in advancements in things such as computing power and in our ability to capture and analyze immense amounts of data. I mentioned the Magnificent Seven a little bit earlier. Many of these companies provide the infrastructure behind the computing power and the data capture that are the foundation for generative AI.
I see here just the race that it took and how quickly ChatGPT accelerated into the market. And we just this past week reached the 1 year mark on ChatGPT. I saw a stat that over 180 million users are now on the platform, and that's just in 1 year. So just tremendous growth in this area. So as we think about that group and this user base, how are other companies utilizing AI, and what's the opportunity for portfolio companies?
Yeah, it's a great question. After all, we are trying to understand the investment implications for AI. We're still in the early stages of what looks to be a very long and powerful period of technological evolution. And companies are trying to figure out how AI is not only going to impact their businesses, but how they can benefit from it. So the chart you're looking at right now shows some of the positive impacts that business owners expect to see from AI going forward. So 3 specific examples involving our portfolio companies include revenue generating opportunities, product enhancement opportunities, and operational improvement opportunities. So for example, Microsoft recently announced its Microsoft 365 Copilot, which provides real-time digital assistance to a number of their products, such as Word, Excel, and Outlook. Microsoft sees generative AI as a revenue-enhancing opportunity, as users will be required to pay an additional fee for this functionality. Intuit is an example of a company that sees generative AI as a product-enhancing opportunity. They are adding Intuit Assist to a number of their popular products, such as TurboTax, QuickBooks, and MailChimp. However, unlike Microsoft, Intuit isn't going to be charging for this functionality, at least initially. Instead, they feel that it'll help enhance products, attract new users, and make products more sticky. A third example is Duke Energy. Duke is using generative AI to capture and analyze power system data, which should lead to operational improvements and savings for ratepayers. So, the reality is that as this technology continues to develop and costs come down, companies are going to find more and more ways where AI can help enhance business operations while driving additional revenue streams.
What other industries do you see benefiting from these developments?
I think healthcare is a great example, and we're already hearing about how artificial intelligence is being used in drug research and discovery, as well as in processing medical claims. I think this area will continue to accelerate going forward. In fact, Google recently announced new generative AI search capabilities for medical professionals. This will allow them to more quickly access data from different systems and sources, freeing up time for patient care. I think that the transportation and logistics industries will be early beneficiaries of AI, and this will certainly be positive for a company like FedEx or UPS, and even to help improve global supply chains. So those are a couple of the industries that I see as early beneficiaries of AI.
So we've talked a lot about the benefits. Everyone knows I'm a glass half full kind of person. I love talking about the benefits, but what risks do we need to be aware of with this new technology?
Yeah, I'd say one of the biggest risks that we are keeping our eye on is just how aggressive are estimates regarding the impact that AI will have on company revenue and earnings, especially in the near term. What often happens during these periods of technological shifts is that the short term gets overhyped and the long term underhyped. So while so much attention is being given to the expected early beneficiaries, the reality is that something like AI will lead to the creation of new jobs, new industries, and investment opportunities that aren't being discussed today. From an investment perspective, it's important that we're skating to where the puck is going and not where the puck is today. The chart right now that you are looking at is similar to one that I showed you just a short time ago, but it's more inclusive. It's not just technology companies. And I think this is important because AI is going to impact industries across the board. This chart shows significant leadership changes over the decades. So for example, all the names that are highlighted in blue fell out of a market leadership position the following decade. What this points to is that it can be very difficult to maintain a market leadership position for an extended period of time. And this can be the result of changes in the competitive environment, regulatory changes, or even other technological and industrial changes. Again, as the result is that, from an investment perspective, it's important that we that we identify and invest in companies that we feel are innovative and can evolve during these periods of change, more so than maybe just investing in the expected early beneficiary.
Are there similar periods of technological advancement that we can compare this to?
I think there are. And I think one of the reasons that we are trying not to get overly excited about AI and its market impact is the dot-com era of the late 1990s and early 2000s. Cisco Systems was a dot-com darling. And at one point over a 4-year time period in the late 1990s, Cisco stock was up over 1,500%. But things didn't end so well for Cisco and its shareholders. In fact, over the following 20 years, Cisco's shares generated a meager 1% annual return. And today, the stock still trades below where it did in the early 2000s. Microsoft is an example of a company that also did well during the dot-com era, but to a lesser degree than Cisco. However, over the following 20 plus years, Microsoft has generated an annual return of about 8.5%, as they have been able to innovate and evolve and grow their businesses through these periods of change. What this tells us is that you can be precisely right about a theme, but precisely wrong about the stock or the timing of a purchase. From an investment perspective, we do feel it's important not to miss out on these big secular changes entirely and to have some early exposure. However, we approach this with caution and with a focus on the long term. Discipline and diversification are really important when it comes to investing in a powerful theme like AI. And as Peter Lynch once said, it's important to know what you own and why you own it.
So we've looked a lot at these public companies, these large cap US based businesses. Let's broaden out. What opportunities and risks do you see for the broader economy?
We do expect artificial intelligence to have a positive impact on the economy and financial markets over time. A strong case can be made that AI will have a favorable economic impact, especially as it relates to productivity gains. I recently read a research report that suggested that generative AI could result in a 7% increase in global GDP growth over a 10-year period. This amounts to about $7 trillion. We see these productivity gains boosting corporate profits. And history does tell us that stocks follow corporate profit growth. As a result, we see AI as a nice catalyst to the equity markets going forward. There is a concern, however, that AI could have a negative economic impact, largely as it relates to workforce reductions as jobs get replaced by computers and automation. But the reality is that our national labor force has actually grown over the decades during the advent of these technological changes, as we are forced to evolve and create new jobs to work alongside these new processes.
And that was perfect timing. We just received a question here from an attendee on the overall impact on employment. So to your point, Matt, while we could see certain roles being impacted negatively, it also tends to create new opportunities. So as we think about that, how could AI impact our role as advisors?
While AI can certainly help our Bartlett team be more efficient in our operations, I don't believe it's going to impact the human element of what we do. In fact, we recently asked ChatGPT if we should invest in technology stocks, and we were told to consult a financial advisor. So I think our jobs are safe for now.
Well, I'm glad to see that ChatGPT isn't perfectly replicating my role as the MC here today, but that means that everyone has to come back next year to see if it's Holly or a chatbot here in front of you. So, Matt, to your point on our role as advisors, there are a lot of technologies that are out there that are being used to enhance productivity and also learn faster and use that generative learning and those large language models that you referenced. One that we're utilizing at Bartlett is called Dark Trace. And this is a system that analyzes inbound emails and learns from them and starts to block the negative ones. So one of the downsides of AI is obviously it's used for all these great things that Matt shared, but it's also being used by the bad guys. So a word to all of you on the webinar with us today, if there's ever anything that makes you say, call Bartlett, call your advisor, and really work through it, because we're seeing an extreme uptick in the number of fraudulent situations. And honestly, as we head into a political season here, we're going to see a lot of AI-generated images that we all need to be aware of. So the bad guys are using it just as much as the good guys. Matt, thank you for that insightful walk through artificial intelligence, the changes that we're seeing today, the changes that we could see in the future. I have no doubt this will not be the last time that we bring this up on a call with our clients, that we will certainly be hearing a lot more about this as we go forward. So this is certainly a bleeding edge technology. This is something that's brand new. It's going to be evolving. Let's pull in Kyle here to talk about a change that we're all feeling in the here and now, a higher interest rate environment and a more persistent inflationary environment. Kyle, can you share your perspective on what this landscape looks like today?
Yeah, first, I think it might be valuable for us to take a step back and talk a little bit about some education. I'm going to be saying, and we'll all be saying, inflation a lot today. And when we talk about inflation, we're really defining that as just the general increase of the price of goods and services. And so that's going to impact each and every one of you on this call today just a little bit differently in your lives. We can measure it a million different ways, but overall, when we say inflation, we're just talking about general price increases. And the Federal Reserve determines that a little bit of inflation is actually good for the economy. So they target 2% inflation for the US economy. And so if we have inflation meaningfully above that 2% target, or meaningfully below, or even if we have price declines called deflation, that's ultimately bad for the economy. So one of the Federal Reserve's roles is to manage inflation near that target. Now, today we have inflation above that target, and their primary tool to reduce that inflation back to target is to raise short-term interest rates. And so many of you, I think, have probably been guilty of complaining about the increase in the price of some of your favorite goods and services. We heard a lot about eggs earlier in the year, or maybe you've even complained about higher interest rates if you've purchase something that's required borrowing. And I can certainly admit that I am one of those people. I'm currently in the process of purchasing a home, and I happened to be on the phone with my dad a couple of weeks ago, and I was complaining to him about how high my interest rate was. It was just too high. And I may have even uttered that it was unfair, but ultimately he laughed, and I couldn't really understand why he laughed. So here we're sharing a chart of why I thought the interest rate was high. This is a historical look at the 30-year fixed rate mortgage interest rate. And you can see that when I was sharing that I had a 7.5% mortgage rate, it did feel high to me because this period of time is actually pretty much my consuming lifetime. And I think if we zoom out a bit, maybe we can see why my dad had a good hearty laugh at my expense. So here's the same chart, except instead of a 20-year history, now we're looking at 50 years. Now, my dad purchased the home that I grew up in 1982. And at the time, he had a whopping 15% mortgage rate. So I think he would have killed for my 7.5% rate. And I think that's why he laughed. But ultimately, I think this story helps kind of frame the current environment. Interest rates have definitely gone up very fast, and interest rates have also gone up very far. But it's hard for us to say that interest rates are high, especially when we think of a longer term view or different periods of time where we had inflation peaks.
What is the potential impact on asset prices of this higher interest rate environment?
Yeah, higher interest rates most certainly have an impact on asset prices, and especially investment assets like stocks and bonds. Here we're sharing a quote from one of our favorite investors, Warren Buffett, and he says, interest rates are to asset prices what gravity is to the apple. And, when you think about gravity or increasing gravity, what we're really feeling is weight or kind of downward pressure or additional downward pressure as it goes up. And interest rates can serve similarly to asset prices. So when we think about bonds, the correlation or the connection to from higher interest rates and bond prices is very direct. If interest rates go up, bond prices go down, and vice versa. But that's not all bad. Higher interest rates aren't, completely bad. With higher interest rates in the bond market, we can expect higher future returns. And, remember, there are two components of a bond return. There's the price return, which we just kind of talked about, but then there's also that income return. And that income component has shown up in a significant way after being nearly absent for nearly a decade. And so ultimately, higher interest rates on bonds starts to favor savers, and in client accounts, we're really looking to take advantage of some of these higher rates. That can look something like taking bonds that are maturing and reinvesting them at higher interest rates, but also making sure that we raise the cash that you need for your future spending, maybe even a little bit earlier since money market funds are paying so well.
Let's talk about stocks.
Yeah. And when it comes to stocks, the correlation between higher rates and stock prices is a little bit less direct. With stocks, other factors like sales growth and earnings growth and many others are also important in determining the direction of stock prices. So although that part is a little bit less direct, where we really see higher interest rates impacting stock prices is through stock valuations. In the past, you've probably heard us mention the price to earnings multiple, or PE multiple, a number of times. And so I think it's pretty reasonable to consider that an investor a couple of years ago looking at the bond market paying something like 2 or 3% might have been willing to stretch their risk profile and buy stocks with an attempt to achieve a higher return than they could get in the bond market. But now, since the bond market is paying something more like 4 or 5%, they might not be willing to pay that 20 times earnings. Maybe they're willing to pay something more like 15, 16, or 17 times earnings today. So we really see that kind of gravitational pull on stock prices, mostly through their valuations.
So looking beyond valuations, what is the potential impact on corporate earnings?
Yeah, higher interest rates make it more expensive to do business for companies, especially if those companies have higher debt levels. So, as it becomes more expensive to borrow, companies may have to decide against some of their future growth projects. They may defer or even have to cancel those. And so that really can have an impact on slowing corporate profit growth. But I want to, make it very clear, this is just additional gravity or additional weight. So it doesn't stop companies from growing their earnings. It does make it a little bit harder, though.
Great. So Melissa, I want to bring you in here and talk about the impact that this has on our assumptions in client financial plans. How are you working in the assumption of higher interest rates and perhaps more persistent inflation into those financial plans?
We review our assumptions annually, but we only make changes when we believe it to be warranted. This year, in light of higher interest rates and the inflation environment, we've adjusted both our forward-looking inflation assumptions as well as our investment returns to reflect that changing market environment. Generally, we prefer to be conservative in our estimates, and given the higher rate environment, we have increased our long-term inflation assumption and our bond return assumptions, but they're still well below, the bond assumption is still well below historical averages. Our assumed equity return for financial plans are slightly below long-term averages as well. And when I say long-term, I mean 20 or 30-year time horizon.
So per usual on the Bartlett way, just a little bit more conservative, which, you know, we want those financial plans to be successful, not just because of really great assumptions in them, but because the plan itself is really intact. So that's great. Can't wait to dive more into those financial planning changes that we should expect. But for now, Kyle, let's go back to you. And we've talked about stocks, we've talked about bonds. What is the potential price impact on physical assets?
Yeah, physical assets are not immune to these higher interest rates as well. You know, I think the physical asset that's on the top of everybody's mind right now has been real estate. We're showing a chart here of housing affordability, and you can see it's fallen off a cliff. It's now at nearly 40-year lows. And in large part, that's due to the higher interest rates that we're dealing with. But I think if you think about the typical American buying a home, they don't look at a house and say, that house is worth $500,000 to me, so I'll buy it. Most Americans are using a mortgage or borrowing to purchase their home. So what they're really doing is saying, I agree to pay that monthly mortgage payment. And that monthly mortgage payment now in 2023 is 73% higher than it was just in 2021. And that's holding everything else equal. So that increase has no impact from price change or any other factor. It's 73% higher solely because interest rates have gone up. So you can imagine that a marginal buyer in 2021 has truly been squeezed out, or will have to reassess what they can and can't afford in today's environment. You know, so overall, I think real estate is a local or regional market. And that means, and I think everyone on the call has seen this before, certain pockets of the country or even their own neighborhood or city can be doing very, very well, while other pockets can be doing very poorly. But generally speaking, we think that gravitational pull on asset prices happens with physical assets like real estate and others as well.
So let's look at the overall economy. What do higher rates mean? And are we likely to face a recession because of these higher interest rates?
Yeah, I think a lot of us in the room, or not in the room, but in the virtual room, have heard that the Federal Reserve kind of tends to raise interest rates too far, too fast, eventually pushing the economy into a recession. And while this isn't perfectly true, we absolutely tend to see things break when interest rates move up as quickly as they have. You know, we saw a little bit of this in the spring with some of the banking challenges around Silicon Valley Bank, First Republic Bank, and even Credit Suisse. But we've also seen really dramatic price declines in some of the higher risk markets so far. Two, I think, kind of interesting examples would be the non-fungible tokens, or NFTs, that we heard a lot about over the last couple of years, and also the special purpose acquisition companies, or SPACs. Both of those have had dramatic price declines. So the impact is happening in certain areas. But I do think it's important for everyone on this call to understand, the Federal Reserve is trying to reduce demand. And reduced demand pressures weaker and riskier businesses or consumers. In some cases, we do expect those weaker and riskier businesses to struggle or fail. So recession is certainly a potential outcome. But I think, recession or not, we value investments in companies with sustainable competitive advantages, and that allows us to stay invested through good economies and bad economies. And ultimately, we expect a number of the investments we have, the companies, to become stronger on the other side of a tougher economy as they improve their competitive position in their industry.
So we've talked a lot about the risks of these higher interest rates, but there have to be some positives to it as well. What positive opportunities are out there in this higher interest rate environment?
Yeah, you mentioned, Holly, that you were a glass is half full kind of gal at the beginning of the call, and I'm dangerously close to being defined as the glass is half empty guy in the firm based on this call. But I will say,
that's why we make great partners, Kyle. We have to balance each other out, right?
Yeah. But higher interest rates really aren't that bad. Actually, for a lot of our clients, whether they're big time savers or they're living off their portfolios and have desired much higher income, especially from some of the safer assets in their portfolios, they're rejoicing right now, and we're rejoicing alongside of them. Some of you may remember my colleague Brian Antonucci back in 2020 for the strategy update. He referenced TINA, and that was short for TINA, which is there is no alternative. And he meant there is no alternative to stocks. And that was in large part due to the very low interest rates of the time. But there is really an alternative now. Just a couple of years ago, it was hard to find a bond that paid 2 to 3% on their yield. And now cash and bonds are available with yields of somewhere around 5% or more. So when you consider that historically stocks have provided somewhere in that 8 to 10% average annualized returns, now cash and bonds are giving you 50 to 60% of those expected long-term stock returns, but you would expect with less risk. So due to the fact that there is an alternative, we're now able to reconsider target asset allocations for some of our clients, especially if we had clients who reached for risk a little bit to try to achieve a greater return. It's a good time for us to reconsider those new target allocations within their portfolios.
So let's shift specifically to look at inflation. What expectations do we have for inflation as we look forward?
Yeah, I think until we see otherwise, we expect it's going to be pretty tough for the Federal Reserve to bring inflation down to their 2% target in a quick fashion. So for us, that means that we expect these higher interest rates for the foreseeable future. You can see on this chart, there are a lot of inflationary pressures that kind of lean into why we're thinking that way. My colleague, Aaliyah Riddle, last year in the strategy update referenced this kind of budding trend of deglobalization or reshoring, or sometimes called nearshoring. But if that was a budding trend last year, we think that's really taken off this year. We have high wages that are sticky and high, and that's largely supported by the very low unemployment rate that exists today. Energy prices are high. We ultimately think those are generally out of our control. And we do think, the housing shortage will take a good amount of time to get fixed. You can't build houses overnight. And so 2 years ago, we saw debt expanding pretty significantly. And in our strategy update, we referenced what debt was in its most simple form. And it was debt is spending today at the expense of spending in the future. And we might really be running into that challenge now. Essentially, we've left a 15-year period of time where monetary and fiscal policies both were in place ultimately to inflate asset prices. And now those policies have switched to kind of slow asset price inflation. I think remarkably, one of the key deflationary items on our list is increasing productivity in the overall or general economy. Mostly on a historical basis, we've seen that through new technologies. So if artificial intelligence that Matt's been discussing is ultimately able to capture some greater traction than we think, it could really help increase productivity and help maintain lower inflation with the Federal Reserve. So I think, we've talked in the past about the old adage, don't fight the Fed. And that's still a really, really important thing for all of us to consider. But we know the Fed's game has changed. They're now trying to bring inflation down. And so that brings along different risks, and it's our job to help navigate all of our client portfolios and get them in position to get around some of these new risks and put you in a position to be as successful as you can.
So we've seen the changes that are coming at us in this new interest rate and inflationary environment. That's just one of the changes that Melissa and our financial planning team are incorporating into financial plans. Melissa, let's transition to you. What are those changes that you and the team are thinking about today?
At a high level, we as planners think about three primary areas that will impact a client's financial plan. So imagine three legs of a stool. There are economic or market changes, policy changes, and major life events.
So let's focus on that first one, those market changes.
As Kyle mentioned, the most significant economic force lately has been higher interest rates. Higher interest rates will make certain planning strategies less appealing, but they make others more beneficial. So I'll start with ones that don't work as well in a high interest rate environment. First, borrowing. In general, over the last 18 months, debt has become meaningfully more expensive. So whereas over the previous decade, it was common for us to get a call from a client, oh, I got a mortgage, or I borrowed for my car, I need a margin loan, almost whether they needed the debt or not, because it was so cheap. Obviously, that landscape has changed completely. And so now we're looking at other ways to fund major purchases for clients. Often we'll have clients who would like to help their child or grandchild fund a large purchase by loaning them money to make the down payment on a home, for example. So again, back to Kyle's example of that $500,000 home purchase, the rate we use on a family loan is called the applicable federal rate, or the AFR. And if we were sitting here in October, November of 2021, that rate was hovering somewhere around 1.7%. And that loan would have cost your child or grandchild, the $100,000 down payment, about $142 a month. But today, that loan is 3 times more expensive. So we're starting to look at potential gifting strategies to accomplish that for clients instead.
So borrowing is less attractive. What types of strategies are now more attractive?
From an estate planning perspective, there are a couple of strategies that we are seeing clients utilize more in this current higher interest rate environment. Those two strategies that have come into favor more recently are charitable remainder trusts and qualified personal residence trusts. Charitable remainder trusts are used for clients who have significant charitable intent. And again, when I'm saying significant, I mean millions of dollars. By gifting assets to a charitable trust, you can get a partial deduction in the year that gift is made. The trust then makes annuity payments back to you for a period of years. And at the end of the term, the charity gets what is left in the trust. The IRS has a minimum threshold for the value of the remainder interest that the charity will receive, and higher interest rates make it easier to meet this IRS hurdle rate and maximize your tax benefit. Again, this is a really good strategy for highly appreciated assets that you're trying to get that appreciation out of your estate. Something like a business that you are planning to sell, or a concentrated stock position with a lot of appreciation inside of it.
So let's transition over to the QPERT, that personal residence trust.
QPERTs are often used by families who have a vacation home or a cottage that they're wanting to transfer as a legacy to the next generation. So the home gets transferred into the QPERT for a term of years, during which time that grantor retains the right to live in the home. And at the end of the period, the home becomes the property of the beneficiary or beneficiaries. The initial transfer is a taxable gift, but the fair market value of the home is reduced by the value of the grantor's right to remain in that home for the period of years. Higher interest rates mean the value of that right is higher, making the amount of the initial gift smaller. Again, there's nuance to it. It's a little bit complicated, but your financial planner can walk you through how it might work for you and your family.
Let's shift to that second leg of the stool, the policy changes. What policy changes should we be aware of?
The biggest policy changes for us as planners often center around tax policy, which changes very frequently. And in addition to them changing it frequently, our friends in Washington also like to change it at the very last second. So last year on December 29th, which was the second to last working day of the year, they pushed through Secure Act 2.0, which contained more than 100 changes to the tax code, but I won't bore you with all of those today. We'll focus on 3 of them. There are a handful of tax planning opportunities that we think will be valuable to our clients. The first is the change to the age for required minimum distribution. The second is a change to catch-up contributions for high earners. And the last is a change to the benefits of 529 educational savings plans. So the biggest change for our clients was moving the age at which you must begin your required minimum distributions. For years and years, it was 70 and a half. Secure 1.0 moved it to 72. And beginning in 2023, the age at which you must begin your required minimum distributions is now 73. For folks who were born in 1960 or later, that age is 75. It doesn't matter for the average American because as soon as they retire, they're going to need their retirement funds to fund living expenses, their daily living expenses. But for the folks on this call, we think that there's a potential tax planning opportunity in those years between retirement and when your required minimum distributions need to come out.
Another IRA tax planning opportunity that many of our clients enjoy are the qualified charitable distributions, or QCDs. Did we see any changes to QCDs?
No, they left QCDs alone. So for clients who are charitably inclined, the qualified charitable distribution, or QCD, the age remains unaffected at 70 and a half, and it will allow someone to make a gift directly from their IRA to a charity without recognizing that income. For those who have a required minimum distribution, it's, again, a really good way to avoid recognizing the income. And it can also be a great strategy for folks who don't itemize deductions. For our clients who do itemize, we might look at other charitable gifting strategies instead, like using highly appreciated stocks.
So a shout out for all of you who do enjoy QCDs. Reach out to your Bartlett team to process those sooner rather than later. Get them done in November instead of waiting till the middle of December on those. There's a little bit of processing time involved. So let's jump back, Melissa, to the catch-up contributions and the 529 changes.
The significant change for clients who are over 50 is that some people are going to be required to make catch-up contributions to a Roth IRA or a Roth 401k. The catch-up contribution must be made to a Roth account if you are earning more than $145,000 a year, which is the amount that the IRS has sort of arbitrarily deemed to be a high earner. We recently received guidance that this change won't become effective until 2026. We think that that's primarily because there are a number of employers that don't have the Roth 401k as an option in their plan. And if they hadn't pushed it out to give them time to make adjustments and add that capability, you've effectively eliminated the ability for somebody to make a catch-up contribution at all. The last change that I'll highlight is a change to the way that you can utilize 529 plan balances. One of the provisions that created a lot of buzz initially was the ability to convert balances that are remaining in a 529 account to a Roth IRA for that beneficiary. There are some caveats to it. 529 plan must have been maintained for 15 years or longer. No contributions made in the previous 5 years are eligible to be moved, and you're limited to the annual contribution amount. There's also a lifetime transfer limit of $35,000 per beneficiary. So we're not recommending overfunding a 529 purposely in order to fund a Roth IRA for your child or grandchild, but it's a really good strategy for folks who are worried about having dollars left over in those plans. It's a way to get money out of the plans without paying a penalty or taxes.
So outside of Secure 2.0, what other policy changes are on your mind?
Biggest policy change for us that's looming is the potential sunset of the Tax Cuts and Jobs Act. Most of the changes that were made as a result of that bill are scheduled to end on December 31st of 2025, assuming that Congress doesn't act to extend some or all of them. The two most relevant to our clients would be the changes to the estate tax exemption and income tax changes. Currently, the estate tax exemption is $12.9 million per person, but beginning in 2026, it will revert back to $5 million adjusted for inflation. So you can think about it as $6 million or so today. We do have assurance from the IRS that they won't go back and tax gifts that have already been made. So in some cases, we are recommending clients use some or all of their current exemption over the next 3 years. From an income tax perspective, the sunset of the current income tax provisions could be painful for some of our clients because beginning in 2026, the highest federal tax rates will go back to 37% from 39.6, and the brackets will compress, meaning you'll get to that top tax rate faster. It's a bit of a double whammy. It's not all bad news. As an Illinois resident, I am looking forward to the sunset of the state and local tax cap, the SALT cap of $10,000. But in places where state income and property taxes are low, like Florida or Texas, where there's no state income tax, it's going to be a painful adjustment because the standard deduction is also set to go back. So unfortunately, for those who don't itemize, that'll be a pretty painful change. But the good news is that miscellaneous itemized deductions come back, so our fees will be deductible again.
So let's look, Melissa, at the overall tax impact. What do you say to a client who says, I know that there's lots of strategies out there, but I just want to minimize my taxes this year?
I'm not sure if there are any accountants on this call, but you're going to have to cover your ears because it's not my goal to minimize or zero out taxes in a given year. I'm trying to minimize taxes over the long haul in order to maximize what's left at the end of your plan. So this chart that you're looking at is a great example of why paying taxes upfront might be a beneficial long-term decision. Here, we've accelerated IRA distributions over the next 3 years. The red bars are the increase in the taxes paid through 2025, and the gray bars going forward are the reduction in taxes paid over time. In this illustration, the total assets left for beneficiaries was significantly more than in the base case. But just like when we're considering Roth conversions for clients, taxes are just one factor that we consider.
So let's look at the third leg of the stool, the personal changes. How do those impact plans?
Personal, the last leg of the stool, I mean, so many things will change through the course of a client's life. Some are joyful, the birth of a grandchild, purchase of a second home, and some are heavy, the end of a marriage due to death or divorce. Whatever the case, we care about you and we're here for you. Your financial plan is meant to work for you and for your goals. So we encourage you to reach out to your Bartlett team whenever something in your life changes, because we're here to listen generously and to spring into action.
As Melissa shared, we certainly are here to listen to all of you, and also here to cut through this complexity and provide a really wonderful level of service for you and your family for many generations to come. Thank you all so much for joining us today. And we have some awesome questions lined up in Q&A. So I think we have about 10 minutes left to go over questions. And I will, panelists, I'll direct these over to you. Quick one on PE for Kyle or Matt. Given all that's been discussed for client portfolios as well as your own, what do you see as an acceptable forward-looking PE for stocks in which to invest? Matt, do you want to kick us off there? And Kyle, jump in as needed.
Let me tee that one up a little, Holly. I think that's, I think that's a hard question to answer. Just, kind of coming at it from our perspective. P is going to be so much different depending on what we're looking at, like what areas of the market. So we do like the fact that, again, going back a week or so, the market's changed a lot over the last week, but we saw, valuations as a whole come down where, PEs a year ago were high teens to low 20s. these were coming down to, high teens to mid-teens, which obviously are very attractive. But I think the other part that we have to answer is, you get what you pay for too. And companies, again, thinking about the Magnificent Seven, which I spoke to, from our perspective, maybe we're willing to pay higher PEs for companies that are going to benefit from these really positive secular changes, or that have these higher growth characteristics, or, thinking about some of the things that Kyle mentioned, companies that don't have to go out and borrow money in this high interest rate environment. So a technology company that's flush with cash, could be in a better financial situation. And as a result, a higher PE multiple might be warranted. So that's kind of one way that we like to look at it.
We have a question here on government debt. I am really concerned about the long-term impact of government debt and never-ending deficits. And it seems like economists are not as alarmed as I am. What impact will the fact that by definition, someday we will need to come to grips with deficit spending have on long-term financial plans? We too are worried about this. Kyle, you want to kick us off on this?
Yeah, sure. I think we've come a long way in a couple of years. I think it was just a few years ago we were talking about, or some of our politicians were talking about, modern monetary theory, which was essentially there's no amount of debt that the US can have where it's a problem or where it will cause inflation. And I think we're seeing very clearly that that's not the case now. I think if the interest expense on the US government isn't as much as the defense budget, now it's on its way there, at least according to a lot of people who crunch those numbers. Ultimately, I think what it means to us is that the government has been able to come in and spend like crazy with 0% interest rates with little to no cost to do it. And now there's a significant cost to do it. And one of the research firms that we subscribe to has done some work on debt as a percentage of GDP. And when your debt gets high enough, that policy from a political perspective starts to favor austerity. And we're kind of approaching that. And I think it's kind of wild for us to think that any politicians, because the last number of decades, no matter what party you like, they've all spent more than the people the year before. And so ultimately, I think there's going to be an impact of, while we're spending all this money on interest and it could be on something productive, we need to get our spending together. So we might have some good things coming in that regard.
We have an AI related question here. Matt, when you think about generative AI models, when do you think they will have real-time data, which might make them more useful for financial insights if they had such real-time data?
Yeah, I saw this question pop up, so I've been giving it a little bit of thought, trying to get a solid answer here. But I mean, some of the models today do have real-time capabilities. They can go out, they can search the internet, they can pull in some real-time data. So some of it's there. As far as the time frame for more of that, I think it's a tough one to answer because there's a lot of unknowns at this point with generative AI. First of all, it's a very expensive technology. So if we're going to be talking about real-time processing, the cost is going to be prohibited, at least probably for the next couple of years till we see maybe some of these costs come down. There's also regulatory risk here. I know the government is digging deep into these companies in this topic, trying to figure out how to regulate it. There's even been people in the industry that suggest we kind of need to slow this down before things get a little bit too out of control. So I think that's going to push that timeline back a little bit as well. I think a big part of it too is going to be the comfort. A financial advisor, if we're talking to a client and we're saying, hey, stock picks are coming from, Chat GPT or whatever, there's probably going to be some skepticism there. So maybe that's the biggest one. How long does it take for individuals to get comfortable that that's going to be a model that we want from our advisor? But I did say this. I mean, I think there are certainly use cases for generative AI in what we do. And, from my perspective as a researcher, to maybe have Chat GPT scan the internet, summarize a conference call or an earnings presentation, things like that, that again, getting back to that efficiency can make me more productive. And I think that's really where the benefit's going to be, over the next couple of years.
Yeah, and Holly, I know the questions are going one way right now, but maybe a question for everyone on the call to consider as this new technology is impacting everyone is, what kind of advice are you comfortable getting from a technology service or a robot? Because by its very nature, generative AI is to produce opinions. And so we have to think from our perspective as fiduciaries for every one of our clients, what would our clients accept, but also where do we cross the line where we're not being a fiduciary on behalf of our clients? And so I would also ask everyone on the call who's a client to think, what do you want from a human being and what do you want from a robot? And I think you'll start to narrow in on where this technology is going within our industry.
Question here on bonds. Do you expect the same trend on bond funds as you do on individual bonds? Kyle, do you want to take that one? Just thinking between individual bonds versus bond funds.
Yeah, we think about this in a fairly simple way. You can have a diversified portfolio of individual bonds, or you can buy a bond fund that's a diversified portfolio of individual bonds. And I think the big difference between the two of them is control. So for example, if you own your own portfolio of individual bonds, you have the choice to buy and sell any of those individual bonds at any point. Whereas if you own a bond fund, you're kind of at the mercy of what that bond fund's doing underneath the hood. But otherwise, we don't differentiate that bond funds should perform better or worse than a similarly diversified portfolio of individual bonds. So I hope that's helpful.
Great. I think we have time for one or two more questions here. I have always believed in a conservative investment philosophy, which has sustained me through the highs and lows. But now in my late 70s, I have less time to make changes. What do you recommend for such age demographics? Melissa, do you want to touch on that one?
Sure. So for us, the way that we determine an appropriate risk profile for clients is to take a look at running, we run a full financial plan, and we take a look at, do you need to take the level of risk that you're taking in order to meet your financial goals? And if the answer is no, then it might make sense to pivot and take some of that risk off the table. In most cases, that would mean reducing your exposure to equities and adding to bonds. It is very client specific. It is also client driven, so it's not age based at all. Some of our clients who are in their late 70s are very comfortable holding a lot of equity exposure, but others are not. And I think the only way that you can really determine whether it's necessary is to run a full plan.
So it's certainly that combination of the ability to take a risk, which is outlined through the financial plan, it's quantified, and also the willingness to take risk. And is this money needed today, or is this generational or going to charity? So the purposes of that. So certainly looking forward to following up with that question asker on anything specific to that individual. One last question here before we sign off today. What do you see as the main, well, I'll back up a little bit. So what are your thoughts on the Fed achieving a soft landing? It's hard to imagine a recession with unemployment so low. What do you see as the main impediments to stop the Fed from reaching its 2% inflation goal? Kyle?
Yeah, I think the main impediments that we see of getting back down to that target, and don't get us wrong, I mean, 3% or 4% is way better than 8 or 9% inflation. So a lot has been accomplished, but it's kind of that last mile that might be the hardest. I think a lot of the main impediments were on the chart that I was referencing around really that low unemployment rate, the sticky wages, high energy prices, kind of that deglobalization that's happening. I was just listening to a speaker the other day talking about how much manufacturing is coming from Mexico for us as we kind of near shore now from China. So ultimately, I think those are some of the main impediments. As far as soft landings, I don't know how sure we can be about whether we're going to get a soft landing or not. We've had a good economy, but low unemployment or the unemployment rate itself is actually a lagging indicator to the economy, not a leading indicator. So if unemployment starts to rise, that generally means that the economy is already having trouble because people don't start firing people until they know they're having an issue. So I wouldn't look at that as a leading indicator to saying we won't have a soft landing. But ultimately, the economy's been very resilient to these higher interest rates so far. I would say surprising to us. And if we can maintain reasonable corporate profit growth, we might have a soft landing. We might eventually get there.
Great. Well, a big thank you to all of our panelists here today, and a big thank you to all of you for joining us all the way through the Q&A. I am amazed by how many folks we have on till the very last moment. We love spending this time with you. We look forward to following up with you. Any follow-up questions, please submit them to your Bartlett team or send them straight to me. Always happy to help. And we look forward to seeing you all very soon. Take care and have a very happy Thanksgiving.